Recently, I read the book Warren Buffett and the Interpretation of Financial Statements by Mary Buffett. It has explained in very simple language how to read a balance sheet and have also shared some insights on how Warren Buffett reads the balance sheet of a company. In this video, I will share with you the concepts I have learned after reading this book. Balance sheet of a company consists of three parts: assets, liabilities, and shareholder equities. Let's start with assets. First heading in the balance sheet is cash and cash equivalents. Under this heading, company records the cash available with it, and it includes cash derivatives, cash and other highly liquid assets that can be converted into cash easily and quickly if required. Cash is generated or accumulated by a company in three different ways: by selling bonds or securities to the public, by selling a business or any other asset, or if the company generates more cash via its operations than it can spend. If it's the third case, it means it is a sound business with unique long-term competitive advantage. The reason is simple. Company is generating a lot of cash by selling its product and services, which in turn means people are buying or paying for its product or services, which at the end means people like its product or services. I mean, there are only two reasons for you as a buyer to buy a particular product or service. First, if you like it or find it better than other similar products. Second, if there is no other similar option. Based on this reasoning, we came to a conclusion that the company under consideration looks good at first glance and can be explored further. To understand how cash is accumulated by the company, it's important to look at least 7 years of balance sheet. By this, one can identify whether the company has sold any bond or an asset generating a one-time cash or has accumulated cash over the time with efficient operations. Check how much it has earned and spent to get a better picture of how the cash is accumulated. And this information you can get by studying the cash flow statement as well as the income statement. Also look at the debt of the company. If a company has enough cash and no to very less debt, it means economics of its business are working great. If a company has a lot of cash or equivalents, then it can steer through the troubling times easily. During bad times, when Mr. Market is treating a company harshly, Warren looks at the balance sheet of a company to see how much cash and debt that company has. If it has enough cash with low debt, probability of the business to come out of this bad time eventually is high. Hence, buying the company when Mr. Market has brought down its share price will be profitable in long term. Next item in a balance sheet is receivables. When a company sells its product or services, its customers have to either pay immediately or after some time like 15 days or 30 days. So the payments from the customers which a company will receive in future for the products sold is the receivables. It is also possible that some vendors will not pay or are unable to pay on time and are considered as bad debt. These bad debts are then deducted from the receivables and we get the net receivables which you can see in the balance sheet. So how to interpret this figure? Well, we need to compare this figure with other companies working in the same industry. If a company is working in highly competitive environment, then it has to offer better payment conditions to its vendor and may extend the period to pay for its products from 30 days to 120 days. Therefore, if we see a company whose net receivables to sales percentage is high as compared to its peers, it will mean the company does not enjoy a unique competitive advantage which we are looking for. On the other hand, if this percentage is lower than its competitors, we can deduce that it holds a unique competitive advantage over others. And the companies with unique long-term competitive advantage are the ones which are going to make us super rich in long term. Next heading in the balance sheet is inventory. Inventory is the item stored in the warehouse that company will sell or use to manufacture the products that it sells. Check the inventory for the past 7 to 10 years, and if there is a consistent rise in both earnings and inventory, it means that the company is able to increase its sales and hence need to increase its inventory to meet the demand. On the other hand, if inventory rises and drops throughout the period, it means that the company is working in a highly competitive environment with good and bad times. This type of behavior is common in cyclical industries like automotive or real estate. And companies with periodical ups and downs don't make you rich in long term. I have also talked about inventories in detail in this video, so don't forget to check this out. Next heading in the balance sheet is prepaid expenses. Prepaid expenses are the ones that company already paid for, however yet to receive any benefits from it. For example, insurance payments which company make in advance of the year. Similarly, the property rent the company pays in advance. Usually this number does not tell us a lot about company's competitive advantage. Similarly, other current assets are the assets that are due and not yet in company's hand. So these are the assets that company will receive in future. I think after understanding all these terms, you can now think and analyze a company better. For example, do not just subtract current assets from current liabilities to know whether company can pay its short-term debts. I mean, you won't get the money mentioned in the prepaid expenses heading of the balance sheet back. You can only avail the product or services which you have paid for. Therefore, although prepaid expenses are in assets, however, they are the money which is gone. So do not assume that it is equivalent to cash that you can use to pay back debt. I think you get what I'm trying to say. I will share more such variations later in the video, so keep tuned. Let's now discuss a term used by many investors to evaluate a stock, which is current ratio. Many analysts simply divide the current assets by current liabilities to get the current ratio. They believe that if the current ratio is above 1, company will have no problem in paying its short-term debts and could be a good investment. At first look, it sounds reasonable as current assets are more than current liabilities. However, as we have just learned, this is not the reality because not all current assets can be converted into cash. Moreover, current ratio being above or below 1 doesn't mean that a company is good or bad. You can find great businesses with current ratio less than 1. Few examples are Coca-Cola and Moody, which have current ratio below 1. Now you must be having two questions in mind. First, if the current ratio is below 1, then how do these companies pay their liabilities? Second, why their current ratio is less than 1? Well, imagine current assets as your savings or liquid amount in your bank account, plus the rent you have paid, plus the insurances you have paid, plus the monthly train pass you have bought, etc. Now, you can pay your debt using your savings only in this example. And if you have more cash in your bank account than the debt that you have, you can pay your debt easily. However, you are also earning income every month or week or quarter, and it is this income or your earnings which you can use to pay off your debt. This is how most of us pay off our mortgage. Most people don't have liquid assets worth more than the mortgage amount, and still they can pay their mortgage off over the years because they are earning new income every month. Similarly, amazing companies earns a lot and thus have no difficulty paying off short-term debts. This answers our first question. Now the second question is why their current ratio is less than 1. Well, as they earn so much, after paying their short-term debts, they still have a lot of cash in hand. And this extra cash that companies have, they share it with their shareholders in the form of dividends, or they use this extra cash to buy back their own shares. This in turn reduces the cash in hand or the current assets number and hence brings the current ratio down and many times less than 1. Let's understand it with a simple example. Let's assume you have a debt of 50,000 with 1,000 as your monthly installment. You have a savings of 20,000 in your bank account and you are earning 4,000 every month. If you calculate your current ratio, it will be 20,000 divided by 50,000, which is lower than 1. But it does not mean that you cannot pay back your debt. With your monthly income, you can pay back 1,000 as debt installment and will still have 3,000 left, which you can use to cover your expenses and then either invest the remaining amount or save it. If you invest the remainder, then your savings won't increase, hence current ratio will remain below 1. However, if you save the remainder, over time your current ratio will go above 1. This is exactly what happens with companies also. I bet you are now getting to understand this language a bit as I am. Now you understand the concept of current ratio and you can now modify it a bit as per your needs, industry and understanding. For example, I usually do not consider inventory while calculating total current assets, as value of inventory varies drastically from industry to industry. If I am analyzing a fashion or electronic industry, I will subtract inventory from total current assets before I calculate any ratio or use this number anywhere. Similarly, if I am analyzing an oil company, I will not subtract inventory from total current assets. Reason for subtracting and not subtracting inventory is simple. Inventory value of an electronic or fashion industry reduces drastically with time as the new electronic models are launched or the product is not in fashion anymore. On the other hand, it doesn't matter to the customer if his or her oil is 3 months old or 3 years old. You see why understanding what each term means and how the value is calculated is important. I will be discussing only the current assets in this video and will cover rest of the headings in the balance sheet in my next videos. Therefore, if you do not want to miss any part of how to read a balance sheet, subscribe to this channel and also hit that like button to show your appreciation.